Thank you. So, as I indicated earlier, we started with the conceptual framework of general purpose financial report. Then we look at the benefits of implementing accrual basis of IPSAS. We look at the authority and role of conceptual framework. And the conceptual framework, role and authority, we started with the role, and where we said the role of the conceptual framework for general purpose financial reporting is to establish the concept that underpin the general purpose financial reporting by public sector entities that adopt the accrual base of accounting. Then we move on to say the authority. The conceptual framework does not establish any authoritative requirement for financial reporting by public sector entities that adopt the IPSAS, nor does it override the requirements of the IPSAS or the RPG. The RPG is recommended practice guideline. So we said that the conceptual framework, okay, the authoritative requirements relating to the recognition and measurement and presentation of transactions and events that are recorded in the general purpose financial report are specified in the IPSAS. So anything that has not been dealt with by the IPSAS will resort to the conceptual framework. So I said that we considered applicability of the definitions, the recognition criteria, the measurement principles, and other concepts that are identified in the conceptual framework. Okay, so we also look at the objective of financial reporting in the public sector. So we said that the objective is very key that you need not to forget. So I said that it provides useful information about the entity, the users of the general purpose financial reporting for accountability purpose and decision-making purposes. So this is the key objective of the financial report that we prepare. We move on to the users of financial report and their information need. We said the primary users and other users, where we mentioned the primary users to be the recipient, service recipients and resource provided, but not all citizens are resource provided. Not all citizens are resource provided. Hello, sorry. So we look at the primary users and the other users, okay? Then we look at the information need of primary users, that is the service recipients and resource providers. Also, we look at the types of reports. We said we have special purpose and general purpose financial reporting. Okay, where we said special purpose financial reports, we are saying that it's being prepared to respond to the requirements of users that have the authority to require the preparation of financial reports that disclose information for their particular purposes. And the general purpose financial report, we said that we prepare it to meet the users that do not have the requirement, the request for the preparation of the financial report for their information need. So we look at the qualitative characteristics of general purpose financial report, where we said we have the relevance, faithful representation, understandability, timeliness, comparability, and verifiability. Well, I told you to take key notice of some of the terms that when you are explaining, you need to look at it. For instance, relevance, I said that it should have what, a confirmatory value and predictive value, or it should have both. So let's not forget, okay? You look at the constraint included in the general purpose financial report, where we mention the materiality, the cost benefit analysis, and we look at the balance between the qualitative characteristics. Very key, let's not forget it. You move on to the reporting entity. What is a reporting entity? A reporting entity is an entity which is what a government or other public sector organization that prepares general purpose financial report. We look at the characteristics of the reporting entity, very key, which I said that it should have what? The entity, the reporting entity is what? Is an entity that raises resources from on behalf of the constituent and or uses the resources to undertake activities for the benefit of or on behalf of what? Those constituents. And I said that another characteristics are what? There should be presence of what? Service recipients and resource provided that depend on the information in what? In the general purpose financial report. Then we look at the elements in the financial statement. What are the elements? I mentioned that we knew of 4 elements, which is assets, liability, revenue, and expenses. So at this level, we are adding 2, which is ownership contribution and ownership distribution. So I said that the ownership contribution, they are saying that their monies, it is what? Monies that comes as a result of what? Contribution from what? The owners. Then the ownership distribution are monies that goes out. It decreases what? The financial position. Okay, but ownership contribution, it increases what? The financial position. Okay, other than what? Revenues. Then we look at what? The nature and purpose of assets in the public sector. The nature and purpose of the assets in public sector, where I cited some of the stages within Ghana. Okay, I cited Kwame Nkrumah Sanders. Okay, so we are saying that government, okay, in the public sector, the primary objective for holding property, plant and equipment and other assets is for their service potential rather than the ability to generate cash flows. So in the public sector, we don't want to generate cash flow. We don't generate profit, but rather we use it what? For service potential. Then again, we are saying the government and other public sector entities may hold items that contribute to the historical and cultural character of a nation or region, where I cited what? The act treasures, the historical buildings and other artifacts. Okay. Then we look at the recognition criteria in the financial statement. We look at what a recognition is, and we look at what the recognition criteria. And we said that the recognition criteria, an item that certifies definition of an element, okay, and the cost can be what? Measured reliably. Then we look at when it is what? It can be probably that the future economic benefit or service potential will that are associated with the asset will flow through to what? The organization. Okay, please, we ended there. We ended at the recognition criteria. So today we are continuing from the measurement of assets and liability. Measurement of assets and liability. So let me share my screen so that we will see what we are going to do today. Okay. Can you please see my screen?
Yes, sir.
See the screen? Thank you. So, we have measurement of assets and liabilities. How do we measure assets and what? And liabilities? Okay, how do we measure? How do we measure the assets that we buy, the assets that we use at the public sector, and the liabilities that we incur? Okay, the obligations, how do we measure them? So first of all, we are going to look at the objective of measurement. What is the objective of measurement? Okay, the objective of measurement. Here, please, I will entreat each and everyone to pay attention. ICAG like asking questions on this where we have gotten to. When we finish, I will expose you to some of the questions that they normally ask. So please, I will entreat you to take your pen and pens, your pen and book to also do some notes alongside. So we said that the objective of measurement is to select those measurement bases that most fairly reflect the cost of services, the operational capacity, and financial capacity of the entity in a manner that is useful in holding the entity to an account and for decision-making purposes. So we are saying that the selection of measurement bases for asset and liability contribute to meeting the objective of financial reporting in the public sector by providing information that enables users to access one. So the objective, we have what? Cost of service. The cost of service, we have the operating capacity, then we have the financial capacity. So let's begin with the cost of service. We are saying that the cost of service provided in the period in historical or current terms, that is what the consumption of assets in the current year. So what are the costs that we incur when we are providing the services? That is what it means. Then the operating capacity. We are saying that the capacity is the capacity of the entity to support the provision of services in the future period through physical and other resources. So here we are looking at what? The resources that we use in what? In operation. That is what we said, resource information. So what are the resources that are there to guide us in operation? So those resources, we are saying that the capacity of the entity to use those available resources in order to provide what? Services to what? To the future period through the physical and other resources. Okay, that is what we mean by operating capacity. Do you have the operating capacity? Then the next one is the financial capacity. Is the entity that you are dealing with have a financial capacity in order to continue providing the services to the citizens? That is what we are going to look at. So we are saying that the capacity of the entity to fund its activities, that is financing information. So do you have the resources in order to finance the activities that you are undertaking to continue providing services to the users within the framework of what? The public sector. So these are the objectives of measurement for what? For assets. Okay, for assets and liability. So we said that the cost of services, then the operating capacity, then the financial capacity. We move on to the asset measurement basis. Asset measurement basis. The asset measurement basis. We have some bases that we use to measure assets in the public sector. So we are saying that the following measurement bases for assets are identified and discussed in terms of information that are provided about the cost of services by an entity, the operating capacity of an entity, then the financial capacity of an entity, okay? And the extent to which they provide information that meets the qualitative characteristics. That means the qualitative characteristics. So we have one, the historical cost. The historical cost. When you talk about historical cost, that is the entry value. That is the entry value. Okay, that is the entry value. The amount you use to buy the asset at the beginning when you are bringing it to the entity. That is what? The historical cost. So we use the historical cost to measure what? The asset that you are buying. Then to the market value. The market value. That is the entry or exit value. We are going to look at it details in the next slide. Then replacement cost. The replacement cost also is an entry value. It's an entry value. Net selling price. Net selling price is also an exit value. Then the value in use, which is the economic value, that is also an exit value. So let's deep down, let's dive down to the details of those measurement basis of what? An asset, how asset is being what? Measured. Okay, so we are saying that general attribute of measurement basis. General attribute of measurement basis. We have what? Entry or exit value. When you talk about entry or exit value, we are saying that entry value reflects cost of purchase. That is the original cost that we use to purchase what? The item. So that is the historical cost or the replacement cost. What is the cost that we use to buy the item on the first entry into the organization? So assuming you are going to buy maybe a plant, okay, and you bought the plant of maybe 50,000. So as at the time you are buying a plant, the cost of it is 50,000. When later the plant cost increases to maybe 60,000, you are not using it, the new cost, to what? To measure it. The historical cost is saying that we should use the original cost, which is the 50,000, to measure the asset. Then we are looking at the exit value, which reflects the amount derived from sales or use of what? The asset. Then the entry and exit value may differ due to unique character of the asset and the transactional cost. Then we look at the market type. The market type. We are saying that the market type, the observable markets are open, active, and orderly, where values can be observed. Okay, where value can be observed. So in this type, we are saying that the market to which we are operating or we are going to operate within should be what? Open, and it should be very active, and it should be what? Orderly in nature. Okay, orderly in nature, in order to what? To have a market what flow. Then the entity specific, non-specific measures. Okay, the entity specific and non-specific what? Measures. So here we are also looking at the entity specific value that reflect the condition of the specific entity. The non-specific value also reflect the general market conditions. So the historical cost, let's look at the historical cost. What is historical cost? As we are saying, historical cost. We are saying that historical cost is the consideration given to the acquirer to acquire or develop an asset, which is the cash or cash equivalent or the value of other consideration given at the time of its acquisition or development. Okay, or development. So the historical cost, under historical cost model, assets are initially reported at the cost and subsequently depreciated over its useful life or impaired. And we are to note that under the historical cost model, the costs remain unchanged despite the changing market value. That is where I cited the example that we bought the plant of what? 50,000. Later, the plant has increased to 60,000. Under the historical cost, we are not looking at the 60,000, the increased price. But when we are going to measure the plant, we are using the 50,000, which is the original cost that we used to purchase. So let me cite an example again. You as an individual, you are buying a fridge. Okay, you've gone to the market to buy a fridge, and they said the fridge is 20,000. Upon buying the fridge, you are bringing the fridge to the house. So when you brought the fridge to the house, the 20,000 that you used to buy the fridge, you use it to buy the fridge. That is what we term as what? The historical cost. So the historical cost is the original cost that you use to acquire the asset upon the entry of what? The entity. What is the objective information that provided in the historical cost? Okay, that is what? The measurement objective. We are saying that cost of service. So cost of service reflects the amount used to purchase or develop the asset that are consumed in the service delivery. Fails to facilitate the assessment of future cost of service in the face of changing prices. So this, it demonstrates the extent to which the budget has been executed. Okay, so we are linking the historical cost towards the measurement of the objective, measurement of objective, okay, in order to explain this. Then the operational capacity. The operational capacity, we are saying that it provides information on the operating capacity when acquired through exchange. So the cost at acquisition is equal to the service potential. So in this case, depreciation reflects the extent to which service potential of an asset has been consumed. That is, resources available for future services is equal to the carrying amount of the asset stated. So non-exchange assets also what? Value reflects nothing on what? The operating capacity. So in the case where, an asset has been what? Donated. Okay, the asset has been donated. That is what? Non-exchange what? Cost. Okay, so the non-exchange asset, we are saying that the value what? Reflects nothing on the operating capacity. So here, when you are looking at the operating capacity, those donations will not what? Be reflected under what? The operating capacity. Then the financial capacity, we are looking at the historical costs that provide information that reflects the amount of assets that may be used as effective collateral for borrowing. Okay, as effective collateral for borrowing. So it does not provide information on the amount that could be received on the sale of an asset, which is what an important measure of the financial capacity. Okay, then we move on to the market values. What is market value? What is market value? We are saying that market value is also another measurement of what asset that we use to measure an asset. So the market value for an asset is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. So the market value of what an asset is the amount for which an asset could be exchanged between knowledgeable willing parties in an arm's length transaction. Why do we say knowledgeable willing party? You, the individual that you are going to buy the thing at the market, you have fair knowledge about the thing that you are going to buy. Then the person also having the intention of selling it to you also have what? The knowledge about the selling of what? The asset. So in that case, that is why we are saying that between what? Knowledgeable willing parties. So you, the individual that you are buying the item, you are willing to buy, and the person also selling it is what? Is willing to sell it to you. Please, are we okay? So in an arm's length transaction, that is what the market, that means the market what exists. Market what exists. Okay, so the market value, that is the amount. For instance, you've gone to Makola to buy an iPhone. Okay, as you are going to buy the iPhone, let's look at something here. When iPhone, when price in the you've researched about the price. That okay, iPhone price is 4,000. Then the person also who is selling the item, the iPhone for you, also himself price say, so what I say, also the so in that case, the two of you are willing because you have fair knowledge about the pricing of what the iPhone. Please, are we clear? But when you get to the destination, that is what the market, that is the open market. The price to which you negotiate and buy the item on is what we call the market value. So for instance, he quoted that the price of the iPhone is 4,000, but you negotiated that, okay, I'll give you maybe 3,500. But later you negotiate hard and you agree on 3,500. So now, because you have fair knowledge and he also has fair knowledge, the price that you agreed on, which is 3,500, becomes what? The market value. Please, are we clear? Please, is it okay?
Yes, sir.
Yes. So price that you actually use to buy it, that is what we term as what? Market value. Okay. So the market value meets financial reporting objective and uses information that are needed when there is what? A quality market evidence. Okay, where there is what? A quality market evidence. So you have what? The evidence that, okay, the price of the iPhone is 4,000. He also have the information, the evidence information that the price of the iPhone is 4,000. But because you guys have fair knowledge, as you met at what? The open market, you agreed. So as you have what? Evidence, you decided to what? To negotiate it to what? 3,500. So then again, the market evidence depends on the characteristics of what? The market. That is the open, active, and what? Orderly what? Market. Okay. As I explained earlier, it depends on the characteristics. Okay. The market you are dealing or you are going to buy the items on. Is it open? Is it active? Okay. If it's open, can you resort to other prices to see, other shops to see? That is the window shopping. Okay. Is the market active enough that you get the iPhone there? Okay, does it operate in the orderly manner? Okay, that will not bring any cheat. Okay, so this is what we term as what? The market value. So the market value and what? Measurement objective. Okay, how do we use the cost of service, operational capacity, and financial capacity in order to achieve the objective of what? The market value. Let's first of all look at the cost of service. So the cost of service, we are saying that the allocation of the cost of assets to reflect their consumption in the current reporting period. That is based on the current value of what? The asset. So in this case, we are saying that the use of the market value permit a return on asset to be determined. However, the public sector entities do not generally carry out activities with the primary objective of generating profit, and services are often provided in a non-exchange transaction or on subsidized terms. So as I said, you are providing the services for them not to pay, okay? For them not to pay. You have acquired the item with a cost, but as you've acquired the item with a cost, we are saying that as you are also providing the services, it should be on what? On non-exchange what? Terms. That's where you are not going to allow them to pay. But even if they are going to pay, it should be what? In a subsidized what? Term. Then operational capacity. We are saying that the information on the market value of assets that are held to provide services in the future period is very useful, which if it reflects the value that entity is capable of deriving from using that particular what? Asset in providing services. Then again, the financial capacity. The financial capacity, we are saying that it reflects information on the amount that will be received on the sale of what? The asset. On the sale of what? An asset. Then we move on to the replacement cost. Replacement cost. Replacement cost. What is replacement cost? The replacement cost is the most economic cost that are required for the entity to replace the service potential of an asset. And this includes the amount that the entity will receive from its disposal at the end of its useful life at the reporting date. So the cost of service, we are saying the replacement cost, okay? The replacement cost, we are saying that is what? The cost, okay? That is the cost. That is the economic cost that required for the entity to what? To replace the services, okay? So when you are replacing the item, maybe you bought the plant, and the plant is worn out and you want to replace it. So the amount which you use to replace the item is what you call the replacement cost. So for instance, you bought the plant of 50,000, but it has gotten like I say, it has spoiled. So as it has spoiled, you need to replace that particular plant. And now the replacement of it becomes maybe 60,000. The cost of replacing the item, the plant becomes what? 60,000. So here, we are saying that we are no more going to use the 50,000 to measure what? That particular asset again. But we are going to use the 60,000 that we used to replace the item to measure it. Please, are we clear? What do we mean by, okay, what do we mean by arm's length transaction? Okay, Mr. Vincent, when you talk about arm's length transaction, the arm's length transaction is where there is what? There is an open market, okay? That is what? There is a market that exists in order to what? To go get the items that you are going to buy, okay? So that is what we term as what? The active, the open, and what? Orderly what? Market. So there should be a system where what you are going to buy, it is not like at any corner. That's what I say. But it should be at a place where it should be open enough that you'll be able to get much information about that particular asset. So what do we mean by the arm's length? Okay, the same thing. Please, is it okay, Mr. Vincent? Is it okay? Mr. Vincent, is it okay?
Yeah, please, it's okay.
Okay, thank you. Then we move on. We move on to the replacement cost and what? And its measurement objective. So we are still using the cost of service, the operational capacity, and the financial capacity. So how do we use the cost of service as in order to what? To link up to the replacement cost. So we are saying that the cost of service provides relevant measure of cost of service in current terms. So the cost of service reflects information on the cost of consuming an asset through the amount of sacrifice of services potential that are incurred by that one, by that to use it, okay? So the operational capacity, it also provides a useful measure of what? Resources that are available to provide services in the future period. as it focuses on the current value of asset and their service potential to the entity. Then we look at the financial capacity. And the financial capacity, we are saying that it does not provide information on the amount that will be received on the sale of what asset. So it fails to reflect the financial capacity. Net selling price. Net selling price. We again use net selling price in order to measure what an asset in the public sector. So what do we mean by net selling price? We are saying that net selling price is the amount that the entity can obtain from sale of the asset after deducting the cost of sales. Okay, so the amount which we obtain from selling that particular asset. So for instance, you are selling what? The plant. Okay, you are selling the plant. So here lies the case, we bought the plant for 50,000, but we are selling the plant, and the plant, as we are selling it, maybe it becomes what, 55,000. So the net selling price after deducting what the cost of services becomes the net selling price that we are going to use to measure that particular asset. And we have to note that the net selling price differs from market value. Okay, the net selling price, it differs from the market value in that it does not require an open or active or orderly market or the estimation of the price in such market, and it includes the entity cost of what? Sales. Okay, it includes the entity's cost of sales. So let's look at the net selling price and the measurement objective. One, the cost of service. So when you talk about the cost of service as a measurement of what? Net selling price, we are saying that it does not reflect information on the cost of service since the beginning of it. And it is not appropriate to quantify the cost of services that are delivered at the net selling prices. Okay. Then again, the operational capacity. We are saying that the operational capacity does not provide information on the operational capacity of the entity. Okay, so the net selling price shows the amount that could be derived from an asset sale rather than the value of the service potential that could be derived from that particular asset. Then the financial capacity. The financial capacity, we are saying that it provides useful information on the financial capacity by reflecting information on the amount that will be derived on the sale of what? The asset. Then we move on to the value in use. The value in use. Value in use is another measurement basis that we use to measure an asset in what? In the public sector. So what do we mean by measure value in use? So value in use is the present value to the entities of the asset, remaining service potential, or the ability to generate economic benefit if it continues to be used, and of the net amount that the entity will receive from its disposal at the end of its useful life. So the value in use is appropriate where the value is what? Is less than the replacement cost and greater than the net selling price. So in all, we are saying that it is what? The discounting figure or the discounting amount of that particular what? Asset. Okay, that is the amount that after we discount that particular asset. So that is what we are saying, that the remaining service potential or ability to generate economic benefit if it continues to be used, and of the net amount that the entity will receive from its disposal at the end of what? Its useful life. What is value in use and its objective measurement? So that again, we use the cost of services. We are saying that it is inappropriate for determining the cost of services. Okay, so the value in use, because as we are using the value in use, the asset is no more generating any service potential. So as we are selling we are disposing the items by selling it. Okay, the cost of service, the cost of it is what is inappropriate for determining the cost of services. Then operation capacity. We are saying that there is what? A limited information on operating capacity of that particular entity, simply because it is what? An exit what? Exit value. In the financial capacity, we are saying that it is yet less useful for assessing financial capacity of an entity because that particular asset is leaving the entity. When it is leaving the entity, using the financial capacity to measure it become what? Very difficult. So therefore, it becomes what? Less useful for assessing the entire general capacity of what? That particular asset entity. Then we move on to the measurement basis of liability. What is the measurement basis of what? A liability. Okay. What is the measurement basis of what? A liability. Here, we are saying that the selection discussion, okay, this selection discussion discusses the measurement basis for liability. So this selection does not repeat all the discussion in the section of an asset. So it considers the following measurement basis. So here, we are saying that we are not going to look at the objective as we have looked at it, the objective of what? Measurement. Okay. So the liability does not have anything relating to what? To the measurement, the objective measurement. Okay. So when it is historical cost, you use it straight away. When it is cost of fulfillment, you use it straight away. So it doesn't have any objective towards it. That is what it means by what? Not repeat all the discussion in what? In the section of what? An asset. Okay. So we have what? 5 main things that we use to measure a liability. First of all, we have what? The historical cost. We have the historical cost. We use the historical cost to measure a liability. We have cost of fulfillment. We use cost of fulfillment to measure liability. We have market value. We use market value to measure what? A liability. Then we have what? The cost of release. The cost of release also we use it to measure what? A liability. Then the last one is what? Assumption price. The assumption price. The assumption price. So let's dive details into it. When you talk about historical cost, you are saying that historical cost is of a liability. Okay, historical cost of a liability is the consideration that is received to assume an obligation, which is the cash or cash equivalent, or the value of other consideration received at the time of the liability. As at the time the liability is what is incurred. Okay, so let's look at something here. Let's look at the historical cost of what? Of an asset. Look at something here. We are saying that the historical cost is the consideration given to acquire or develop an asset. Okay, so you realize that the definition of what? The liability, which is what? The historical cost, does not differ at all. The only thing is what? The introduction of what? The obligation. Okay, the introduction of what? The obligation in what? In the definition. So when you remember, when a question is asked and you remember the definition of historical cost for an asset, and the question is asked on what? A liability. Please, the difference is what? Is the obligation that is here. Okay, so we are saying that historical cost of liability is the consideration that is received to assume an obligation, which is the cash and cash equivalent, or the value of the other consideration received at the time of what? The liability is incurred. So let me give you an example. You've gone for a loan. Okay, you've walked to maybe Ghana Commercial Bank to go for a loan. You said that you want a loan of 50,000. Okay, so the 50,000, mind you, the bank will charge you interest. Please, are we clear? The bank will charge you interest. So the loan that you've gone for become what? A liability. That is what? An obligation that you are going to fulfill. So the 50,000 become what? The historical cost. Okay, the 50,000, the actual 50,000 that you requested and the bank has given to you become what? The historical cost. Okay, please, is the example okay here for you? The actual amount that you requested for the loan, which is the 50,000, minus the interest, become the historical cost of what? The obligation. So that is why we are saying that it is what? The consideration received to assume an obligation. Okay, which is the cash or cash equivalent, or the market, the value of the other consideration received at the time the liability is what? Is incurred. So as you walk into GCB to acquire to procure the loan, you said you want 50,000. The bank will charge you interest, but we are using the historical cost which is the 50,000, to measure that particular obligation under the liability. Okay. Then 2, the cost of fulfillment. Cost of fulfillment. You use cost of fulfillment to measure a liability. So what is cost of fulfillment? The cost of fulfillment is the cost that the entity will incur in fulfilling the obligation. Is the cost that the entity will incur in fulfilling the obligation, represented by the liability, assuming that it does so in the least costly manner. Okay. So here, the cost of fulfillment, we are saying that you add the interest to the 50,000 that you are going to procure. Okay, so the interest plus plus the principal becomes the cost of fulfillment. When you are fulfilling the obligation to the bank will charge you an interest together with the principal. Okay, so the total amount of the loan that you are going to pay, that is the principal plus the interest become the cost of fulfillment. So we use the cost of fulfillment, that is the interest plus the principal, to measure that particular obligation that you've gone for with the bank. Please, is it okay? Is it clear? Is it clear? When you are going to settle your obligation, which is the 50,000, okay, to the bank will take you the interest plus the principal, okay, plus the principal. So the interest plus the principal becomes the cost of fulfillment. So when you are going to fulfill the obligation, pay the obligation, that is the cost of the actual amount that you are going to pay. Then we move on to the market value of a liability. Market value of a liability. The market value is is the amount for which a liability could be settled between knowledgeable, willing parties in an arm's length transaction. In an arm's length transaction, a liability could be settled between a knowledgeable, willing parties in an arm's length transaction. The cost of release. The cost of release is is similar to net selling price, which refers to the amount that either the creditor will accept in settlement of its claims, or a third party will charge to accept the transfer of the liability from the obligor. Okay, so here, let me give an example again. You've gone for the loan. As you've gone for the loan, which is 50,000 plus interest, you've lost your job in the process. You are unable to pay the loan plus the interest. Then you resort to a third party to pay the loan for you. For instance, excuse me to use their names here. Maybe Emmanuel has gone for a loan from a bank, which is 50,000 plus interest. I'm not saying it should happen, but in the course of it, Emmanuel could not be able to pay the loan due to certain circumstances. So he has resorted to Regina and Florence to settle the loan for him. So, okay, Florence will tell you, okay, I've accepted it, but you need to pay certain charges for me to accept the transfer of the liability. Okay, so the amount to which the additional amount that Florence is going to charge on the loan that he's going to settle on behalf of on behalf of Vincent is what we call the cost of release. Okay, the cost that will release Vincent from from paying the loan. Okay, so Florence is going to pay the principal plus interest together with additional charges that she's going to charge Emmanuel to pay that particular loan for him. Please, is it okay? So the cost of release is similar to net selling price, which refers to the amount that either the creditor will accept in settlement of its claim, or a third party will charge to accept the transfer of the liability. Please, are we clear? Please, I want you to understand. Is it okay? Is the practical session okay for you? Hello? Are we all here? Colleagues? Hey. Colleagues, are we all here?
Yes, sir. Yes, sir.
Is the examples okay for you?
Yes.
Okay.
Please, can you distinguish between the...
We are getting the understanding, right?
Please have a question.
Is the like, are we getting the understanding, please?
Yes, sir.
Yes.
Okay,
Yes, sir.
thank you. So let's move on to the assumption price. The assumption price. We are saying that it is similar to replacement cost. Okay, it's similar to what? Replacement cost. So assumption price is the amount which the entity will rationally be willing to accept. What will be rationally be what? Be willing to accept in exchange for assuming an existing what? Liability. Okay, in exchanging what? Existing what? Liability. Please, are we clear? So the assumption price is what? The amount which the entity will rationally be willing to accept in exchange for assuming an existing what? Liability. So upon Florence accepting to pay, then she will go to the bank to negotiate on terms what? With the bank. Okay, so if the bank also agreed that, okay, I'll slash it down for you because Vincent is unable to pay the loan. So the amount that is going to be agreed between what? Florence and what? And the bank will be what we call what? The assumption price. So that is the price to which the person is going to pay to settle that particular what? Obligation. Please, is it okay for us?
Please, I have a question.
Okay.
Please, can you the example that you give under historical cost and the cost of fulfillment? Can you please throw more light on that for me?
Okay. We are saying that historical cost. The historical cost, when historical cost for what? For a liability. Okay. When you go to the bank, you are going to procure a loan. The loan that you are going to procure, you say you want 50,000. So the 50,000 that you are procuring as the loan, less what? The interest. Okay, less the interest become what? The historical cost of measuring that particular what? Obligation. So the 50,000 without the interest become what? The historical cost that they are going to use to measure the liability on the face of what? The financial. Okay, then the cost of fulfillment. Okay, the cost of fulfillment. You are saying that the cost of fulfillment is what? The principal plus what? The interest. The principal plus the interest. When you are going to settle that loan, the 50,000 to the bank, when the bank gives you a loan, bank will charge you interest. So when you are using cost of fulfillment as a measurement of liability, the cost of fulfillment becomes what? The principal plus the interest, which we'll use to what? To measure what? That particular liability. So the cost of fulfillment in the layman understanding is what? Is the principal plus what? The interest. The market value. So the market value, okay, it is the amount for which a liability could be settled between knowledgeable willing parties in an arm's length transaction. So that is what? The negotiated amount. Okay, maybe the bank said he's charging maybe 20%. But if because of the loan that you are taking, the hugeness of the loan, he said, okay, let me give 18%. So upon agreeing on what? On the 18%, it becomes what? The market value. So they use the 18% in order to what? To charge on what? The actual amount that you've gone for. Please, are you okay? So that is what? The amount which a liability could be settled between knowledgeable willing parties. So the amount that both parties have agreed. Then the cost of release. The cost of release become what? The amount the creditor will accept in settlement of its claim. And I gave you an example that maybe Vincent is going to procure a loan. He has procured a loan, but he is unable to pay the loan. So he has resorted back to what? A third party to pay the loan for him. Okay, so this third party will tell you that, okay, I'll pay for you, but I won't do it free. Okay, I won't do it for free. Okay, so if I'm not going to do it for free, the amount which I am charging you in order to accept that obligation on your behalf become what? The cost of release. Okay, so for instance, the loan plus the principal plus the interest become what? Maybe 70,000. But here lies the case: when Florence, a third party, wants to settle the loan for you, she will tell you that, okay, I am also charging 2,000. Okay, so the 2,000 become what? The 2,000 plus what? The 70,000 become what? The cost of release. Please, are we clear? Become what? The cost of release. Please, are we clear? That is what the third party has charged you, the Vicent, to pay the loan for you. Then the assumption price. The assumption price is what? The amount that has been agreed between what? Florence and the bank. Okay, Florence has gone to the bank to negotiate. Okay, this person is not able to pay, but let's see, bank, I am going to pay on his behalf. So let's see if you can slash it down. So if the bank has also slashed it down, then it becomes the leftover amount that Florence is going to pay become what? Assumption price. Assumption price. Please, is it well understood for us?
Yes, sir.
Okay, so on this note, we are done with the conceptual framework. On this note, we are done with the conceptual framework. So let's look at some of the questions that asked students over the previous year. Okay, the previous system. They are saying that according to the conceptual framework for general purpose financial reports, the objective of a measurement in financial reporting in public sector entities is to select those measurement bases that most fairly reflect the cost of service, operational capacity, and financial capacity of the entity in a manner that it is useful for accountability and decision-making purposes. You are required to explain under listed bases and discuss the extent to which each measurement reflects the cost of service, the operational capacity, and the financial capacity of an entity. So 1, historical cost, 2, market value, and 3, replacement cost. Mind you, I exposed you to the objective of each of the measurement bases. So that is what you are going to use to explain it for the person, okay, for the examiner. Please, have you seen how the question has been asked? Okay,
yes, sir.
So you explain what the historical cost, then you link it to the cost of service, the operational capacity, and what? The financial capacity. Then again, you explain what? The market value. What is market value? It is the amount to which an asset can be exchanged between what? A knowledgeable willing parties. Okay, then you use what? It in connection with what? The cost of service, the operational capacity, and financial capacity. Then again, the replacement cost, the cost to replace what? That particular asset. Then you explain it in line with what? The cost of services, the operational capacity, and what? The financial capacity. What is the objective of what? Each of what? The asset, the measurement basis. Then again, they said implementation, another question, implementation of the International Public Sector Accounting Standard is a priority of government in 2021, and the Controller and Accountant General is doing everything possible to ensure effective implementation. One major concern of the implementers is a measurement of public assets, as these assets are numerous, varied, and acquired in different ways. Nevertheless, assets need to be measured and recognized in accordance with what? With the IPSAS. Okay, so we are saying that an entity that adopts the IPSAS automatically is what? Adopting the accrual basis of accounting. So you need to what? Measure the asset. So you are required, explain the objective of measurement in financial reports under the IPSAS. That is 4 marks. So you are going to explain the cost of services, the operational capacity, and the financial capacity. That is the first requirement. They say what? Explain the objective of measurement. So what are the objectives of measurement? That is what? The cost of services, the operational capacity, and what? The financial capacity for 4 marks. Then again, explain 4 measurement bases for assets in line with the conceptual framework for general purpose financial report. Please listen to the question. Explain what? 4 measurement basis of what? Asset. So how do we measure what? Asset. We measure assets with what? Through the historical cost, through the market value. Okay. So those that I've exposed you to, those are the ones that you are going to use to explain. Okay. The replacement cost. Okay. The net selling price. Okay. That is what you are going to use. That is, and what? The value in use. So please, let's be mindful of the question. Okay, the first one talks about the objective of what? Measurement. The objective of what? Measurement. Then the next one talks about what? The measurement basis of an asset. The measurement basis of what? Of an asset. Then the third question. Some accountants hold the view that development of conceptual framework for general purpose financial reporting, simply the conceptual framework in the public sector is needless and mere information overload on the accountant. This argument is predicated on the fact that the conceptual framework does not establish authoritative requirements for financial reporting by public sector entities that adopt the IPSAS. So here they are telling you about what? They are telling you about what? The rules and what? The authoritative. Okay, nor does it override the requirement of what? The IPSAS. Okay. Then the question asks, somebody's hand is up. Okay, Emmanuel, please ask a question.
Oh, no, then maybe this thing.
Okay. So the question said required. Explain in connection between what? Explain the connection between the conceptual.
Now this is my other Emmanuel Awesome.
Oh, okay. Ima, are you there? Yeah, Emmanuel Awesome. Yeah, Emmanuel Awesome. Please ask your question. Emmanuel Awesome. Okay, let's move. Also, explain the connection between the conceptual framework on one hand, and IPSAS and RPG on other hand. Okay, so here you're going to explain the conceptual framework. What is the conceptual framework? Yes.
With regard to question, the A, the B. Yes, please, can you hear me?
Yes, please. Is it this one? Ima, please, which of the question? Oh, his network. Oh, his network is bad. Okay, let's move. He said, explain the connection between the conceptual framework on one hand and IPSAS and RPG on other hand. So here you are going to clearly tell the examiner, okay, you are going to use what? The conceptual framework, the authority and the rule. Okay, mind you, the conceptual framework, okay, is just there to guide the preparation of what? The general purpose financial report. Okay, by things that have not been dealt with for the IPSAS. But the IPSAS is what? It's an international standard that you can't what? Override it. Okay, so you need to go straightly about it. So you need to let the examiner know all these things for 2 marks. Then illustrate a practical case where the conceptual framework will be useful to an accountant in the preparation and presentation of what? A general purpose financial report. So here, they are going to let the examiner know that there are certain things that have not been dealt with by what? The IPSAS. So the conceptual framework is just there, okay, to fill that potholes. So you cite a practical example with that. Then again, explain 2 constraints on the information included in the general purpose financial report. What are the constraints? We said the constraints are what? Materiality, the cost and benefit, and what? The balance between the qualitative characteristics. So I explained that one earlier. So that is what you are going to use to explain. Mind you, the question is saying that constraint that is included on what? The general purpose financial report. Please, are we clear? Are we clear? So you need to know all these things. You need to know all these things before the exams period, because you might not know which one is coming. Is that clear? So this is how questions have been set over the years on the conceptual framework, which is 50 marks. Last two sittings and last sitting, they didn't ask anything on conceptual framework, but we don't know what is happening. But please, let's be mindful. You don't know your regime. Let's try as much as possible to cover it up, because it's part of the syllabus, which is 50 marks, to know what the conceptual framework generalized. On this note, we are done with the conceptual framework. Any questions so far, please? Any question? Any question, please? Colleagues?
Not from me, sir.
Emmanuel, so it seems your network. Is it okay now? Any question?
Oh.
Vincent, any question? Emmanuel, Beleza, any question? Derek?
No, not from me. I'm okay.
No question.
Okay.
So you can proceed.
Thank you. So let's move on. Stop sharing my screen. Okay. IPSAS. What is IPSAS? We are saying that IPSAS is the accounting standard for public sector issued by the IPSAS board. Okay, it is what? The accounting standard for what? Public sector that is being issued by the IPSAS board. So we are saying that the IPSAS board has the responsibility for one, setting high quality accounting standard for the public sector across the world. Then two, promoting the adoption and convergence of what? The IPSAS. Then three, issuing recommended practice guide and other publications to support the implementation of what? The IPSAS. So when they bring a standard, the IPSAS board try as much as possible to bring a guide. Okay, so this guide is referred to what? The recommended practice guideline. That will aid you when you are adopting what? That particular standard. Okay, so we are saying that there are two versions of what? The IPSAS. You have the cash basis IPSAS and the accrual basis IPSAS. Cash basis IPSAS and accrual basis IPSAS. Okay. So let's look at the cash basis IPSAS. The cash basis IPSAS, you are saying that it allows for transparent financial reporting of cash receipts, payments, and balances under the cash basis of accounting. Mind you, this one is not different from the cash basis of accounting. Okay, as we earlier looked at. It was issued to help those countries reporting on cash basis to improve their performance. So Ghana adopted the cash basis IPSAS in what? 2009. This is where Ghana adopted the cash basis IPSAS. Okay, so this one is not different from what? From the cash basis of accounting that we looked at earlier. Then again, the accrual basis of full IPSAS. The accrual basis or full IPSAS. When you are using accrual basis, that means that you are adopting what? The full IPSAS. You are implementing what? A full IPSAS. And this is where Ghana, we are facing challenges. They said we should adopt the IPSAS. That is the accrual basis of IPSAS, accrual basis to prepare financial statement. But it became what? It's becoming challenges. Okay, so let's look at the accrual basis IPSAS. We are saying that it focuses on revenue, cost, asset, liability, and equity instead of cash flow only. Okay, instead of cash flow only. So here it blends what? The accrual basis to what? To the cash accounting, the cash basis, for it to become a full IPSAS. So it is on accrual basis, which is in line with the IFRS. It is on what? The accrual basis, which is in line with what? The IFRS. Okay. Then Ghana is here to adopt full version of what? The standard. Even though they said we should implement the accrual base, but it is becoming difficult because we have not adopted it fully. It is not what? Been adopted fully. So the pronouncement of the IPSAS board, we are saying that the pronouncement of the IPSAS board take the form of one, a conceptual framework for general purpose financial reporting in the public sector, which has what, 8 chapters. 8 chapters. Which has what, the 8 chapters. That is what you just look at. Okay, that is just what we have just looked at. Then international public sector accounting standard, which is what, IPSAS. Currently we have what, 40 standard. Okay, currently what we have what, no, it is 42 standard. Sorry, it's supposed to be 42 standard. Okay, but we have the one that based on what, IPSAS, which is 40. The one that based on IPSAS is what, is 40. Then the recommended practice guide, which has what, 3 issues. Okay, 3 issues. Let's not bother ourselves on this. Okay, what we need to know is the content within the 2. Then we move on to the objectives or benefits of adopting IPSAS. What are the benefits a country will derive from adopting the IPSAS? Or what are the objectives for adopting or for a country to adopt the IPSAS or the full what, accrual basis? 1, to enhance transparency and accountability of financial reporting in the public sector. When you are adopting the IPSAS, we are saying that it is going to enhance what, the transparency, and it will enforce accountability of financial reporting in the public sector. Whatever that you are doing in the public sector, there should be what is going to bring what, transparency. It is also going to enforce accountability. 2, to improve the decision usefulness of financial information in the public sector. Improve the decision usefulness of financial information in what, in the public sector. Mind the users what, request for financial report in order to what, to make their decision and what, to enforce what, accountability. So when IPSAS is fully what, implemented, therefore we are saying that it is going to what, enhance the decision what, making of what, that particular user. 3, to ensure comparability of financial statements across different organizations and countries. To ensure comparability of financial statements across different what, organizations and countries. Why are we saying this? Because the IPSAS is what, is an international base. Whatever Ghana is doing, we are doing it in compliance with what others are doing over what, the other countries. So when you prepare financial statements using what, the accrual basis or the IPSAS, then we are saying that you are also going to be able to use it to compare what other country, say maybe Nigeria is also what, using. So your financial statement can be what, compared because of this particular what, unique what, IPSAS. Then the next one is what, to ensure better measurement of the performance. To ensure better measurement of what, performance. And mind you, we are saying that, you know, I told you that when we were looking at what, the accrual basis of accounting, we are saying what, it includes what, subjective what, judgment. Okay, so everything is inclusive. So if everything is inclusive, that means that it's what, it better the measurement of what, performance. You'll be able to use it to measure what, whether a country is what, is progressing or what, is not progressing. That is what we are saying, that public sector entities in terms of what, cost of services, efficiency, and what, accomplishment. So here is government what, providing cost of services in efficient manner. Okay, are you also accomplishing it? Okay, so that is what we term as what, better measurement. Then the next one, also improve access to financing in the capital market through bond issues. Improve access to financing in what, in the capital market through bond issues. So those are the objective or measurement of what, adopting IPSAS. They can ask you, what are the benefits a country will derive when they implement full IPSAS or when they adopt what, IPSAS. So let's be mindful of them. The reason for adoption. What are the reasons for adoption IPSAS in the developing countries? Why do we adopt the IPSAS? Why do we adopt the IPSAS? We are saying that many countries have adopted the IPSAS. Okay, many countries have adopted what, the IPSAS, for the following reasons. And what are the reasons? 1, in order to improve the quality of general purpose financial statement. In order to improve the quality of general purpose financial statement, we want quality. The financial statement that you are preparing, you want quality of it. Okay, so if you want quality, that means that we need to what? To subject to what? The IPSAS. In order to what? To have a standardized one to get quality of what? The financial statement that we are preparing. 2, to enhance transparency and accountability. Okay, to enhance transparency and accountability. And I told you that the objective of general purpose financial statement is what? Is to provide information for users for what? For their decision making and what? Accountability purposes. So here, once you are preparing the general purpose financial reporting, we are saying that it will enhance what? Transparency and accountability. We are going to enforce accountability, okay, in managing financial management as indicator of good governance. Okay, as indicator of what? Good governance. Whatever the stewardship you are providing, okay, the services that you are providing, you should be accountable because we are using what? Public funds to provide those services. Okay. Then 3, to conform to the international trend. To conform with what? The international trend. Whatever is going on in other countries is supposed to be what is going on in Ghana, because we are using the same what? The same standard. 4, to comply with regional grouping requirements. Regional grouping requirements. Example, the AU and the AUs, okay? The AU and the what? The EU, that is the European Union, okay? The European Union. And the last one is what? Donor pressure as requirement for borrowing. Donor pressure as requirement for borrowing. That is what? World Bank and International Monetary Fund, that is IMF, okay? So because we are using the IPSAS, we are saying that when we are going for loan, because we are adopting the IPSAS and the same standard, it won't be difficult. Okay, so there won't be any pressure for the requirements that are going to come alongside with the loan that we are procuring. The next one we are going to look at are what are the arguments against the adoption of IPSAS? What are some of the arguments that comes in? Would this thing be okay? Will it achieve its purpose? Will it be achievable? Those are the arguments against the adoption of IPSAS. So we are saying that most commonly cited arguments against IPSAS adoption are: it undermines the sovereignty of the state in financial markets matters. It undermines the sovereignty of the state in financial matters. Then the next one is it's very costly to adopt since huge database of assets and other transactions are required. Since what? Huge database of what? Assets and other transactions are required. Then the next one is what? It is also seen to be complex. It is also seen to be compressed and does not meet the need of developing countries. Okay, mind you, when we are treating the disadvantages of what? Accrual basis. Okay, we are saying that it is very complex. It is not easy to be understand. Okay, then the next one is what? The expertise required to successfully operate the system is lacking. Here we need what? Full special people. That is expertise. It requires high expertise in order to what? To implement the full IPSAS. And then last one we are going to look at is what? Likely inconsistency with national legislation. Likely inconsistency with what? National legislation. Okay, then the IPSAS implementation challenges. The IPSAS implementation challenges. Most countries adopting the IPSAS for the first time as transition from the cash basis IPSAS are facing a lot of what? Implementation challenges. And what are the implementation challenges? 1, lack of political will and support. Lack of political will and support. Because this person is not this person regime. Okay, and you know that they buy, and you know that they buy, say implement it. So because of that, when next government come, you won't what? Support it. Okay, you won't support it. So because of that, it becomes what? Challenges for implementing what? The IPSAS. Then difficulty in identifying and valuing public assets. Difficulty in identifying and valuing what? Public assets. Here, when they said we are going to adopt the IPSAS, the accrual basis of IPSAS, they need to what? To go back from the beginning, that is scratch, in order to value all assets. Okay, in order to value all assets. So the difficulties in identifying those assets to be valued is preventing what? The implementation of what? The IPSAS. Okay. Then the next one is what? Huge cost of implementation. Huge cost of implementation as a result of revaluation of assets, high cost of expertise and training. Okay, here when you are going to train the expertise, okay, you are looking at it, the cost that you are going to hire for hiring of what? The expertise, and the cost you are going to incur as a result of what? The revaluation of public assets is what is also preventing the full implementation of what? The IPSAS. Then the next one is what? Lack of expertise and strong regulatory body. Lack of expertise. We lack people that will implement it. Okay, chartered accountants are not many in the system. Okay, there are not many in the system. So because of that, it becomes more difficult implementing it because of what? The expertise. Then the last one is what? The complexity of standards leading to lack of appreciation among policymakers. Complexity of the standard. You know, the accrual-based IPSAS, it is very complex, as we stated at the disadvantages level of what the accrual basis. Okay, because of its complexity nature, okay, it becomes difficult for the policy makers to appreciate the standard. Okay, so which is becoming what? Very difficult in implementing what? The accrual-based IPSAS. On this note, we end the IPSAS. Okay, on this note, we end what? The accrual-based IPSAS. So here is where we draw curtains on what? The IPSAS. Please, any question? So when a question will be asked, these are the areas that will be asking you. Okay, first of all, the objective or benefit when a country adopts the full IPSAS. Then the reason for adopting the IPSAS and what the argument. So the argument can be looked at what? The same as what? The challenges. Okay, when you are explaining, you can interchange them. Please, are we clear? So these are the things. So they mostly like asking questions on the implementation challenges, the reason for adoption, and the objective. Okay, the benefit. So let's be familiar with all these things. Mind you, when we were starting the conceptual framework, I gave you areas. That is what? The benefit of adopting accrual-based IPSAS. So these are the benefits. It's the same benefits. Please, are we clear? So they like asking questions on it. Going forward, I'll try as much as possible to get you some of what the questions that have been asked. Please, any question on this? Any question on this so far? Colleagues, any questions? Any questions so far, please?
I think we are fine.
You are fine, eh? Okay.
Yeah.
Okay. Let me stop sharing my screen.